Money is not neutral. It carries culture, history, and expectations.
Join us for honest conversations about the real costs behind how we live, love, give, and just survive in this complex world.
Money. It is not black or white.
Powered by GoTyme.
Inna Mapalomaku.
And I'm Maya Fisher-French. Welcome to our podcast.
Maya, we often talk about credit, we talk about debt, how to build your credit score, how to get out of debt, but we never or have not yet spoken of what happens when your debt is handed over, or as some people say, you are blacklisted. And that's the conversation we're having today.
And we're using a real case scenario. So I've got somebody, Vui, who I'm very grateful to her to share her story with us. Because Maplo and I do a little money boot camp thing. And
don't say little. It's a big thing.
It's a big thing.
We are changing people's lives.
We are changing people's lives. Sorry. It's not small. It's a really big deal. And we get these candidates in. And I remember getting Vui's application. And you and I sat there and we were like, who's taking this one? Because this one's going to be really tough. She had so much debt. She was supporting 20 family members. And we were like, I don't know, this woman she's in a lot of trouble. But what she did is she started to take control. She started doing the budgeting and she started setting boundaries for the family, which were a really big part of it. But I want you to hear directly from her. You're going to hear from her now as to where she is right now.
Currently, I'm almost debt-free. I'm only left with Capitec. I was actually drowning in debt. I remember when we were doing my budget, me and Maya, I was always on a minus. So it's good to actually do your budget and still see money in your account. I'm actually now saving. I've paid off ABSA. ABSA was the biggest debt that I had because I was owing about 88,000. So what happened with ABSA is they reached out, they sent me an SMS and an email. They gave me a 65% discount. So I was supposed to pay 9.5, 9.6 for the next 3 months. That offer, I got it towards end of November. So we did our checks, myself and Maya, just to check if it's legit and all that, because we were both skeptical. But me being talkative as I am, so I also asked about other people. So there was a few that said that they did the same thing. They got the discount, and that's how they got out of the debt. So it was difficult for me to pay that 9 point something from November, December, and January. But now I thank myself. I'm only left with Capitec, of which I'm finishing end of September. So yeah, Money Boot Camp really helped me. It taught me to say no, to stop being a people's pleaser and just focus on me and my kids.
Amazing thing when you listen to that voice note is that 18 months later, she's debt-free. She's going to be debt-free in September. But a really big part of that, Maplo, was the bank debt, that she was able to settle it at 65% less. 65% less. And this is something, as you said, we haven't really explored, is how do you get to negotiate with your creditors? Yeah. And I have brought on an expert in this field. So welcome Ian Wood. He is CEO of Alefbet Collections and Recovery. So Ian, I know it's not a nice word, debt collector. It's a little bit of a swear word, but you are a debt collector.
I am indeed that.
You are a debt collector, but he's one of the good guys. I do often coach you guys. You often assist me, and you assist some of my readers in understanding how to manage this process when your debt's been handed over. But can we take a step back now and just that story of that she got to settle this debt? Just explain this world of debt settlement.
Certainly. And thanks very much for having me on your show. So around, generally credit providers will lend money to customers that they believe will be able to pay the debt back. So there's a bit of a technicality around that. So as you lend money, you then have to raise an IFRS 9 provision for potential accounts that'll go bad. So a credit provider, as the account goes further and further in arrears, would be raising this provision to a higher and higher amount. But the intent is always to work with the customer to bring the account up to date. And that's in the ideal world. But in some extreme situations, like you explained, the debtors got further and further in arrears where the person is just overwhelmed with their debt. So as a debt collector, we get handed over accounts from, various banks, various credit providers. And when they sort of get beyond the customer, credit provider relationship, it sort of changes from a customer to a debtor. At that point in time, they're either in pre-legal or in legal, or the credit provider has handed it over off balance sheet. So at that point in time, they're not intending to offer any more facilities to this debtor now, no longer a customer, because they're not intending to do business with them again. At that point in time, they will offer a settlement discount, because they then say, okay, what is the debt worth in my books? If I get a settlement, will I be better as the credit provider by taking the settlement? So they will offer a single payment settlement, and sometimes over 2 or 3 months, in this case, where the person can settle their debt and get out of debt from their perspective. That's one side where the debt it comes from. The other side is where a bank has handed over and written off their balance sheet the debt. They sometimes sell the debt to places like ourselves. We buy debt, and so we will buy the debt at less than face value. So, example, we could buy it at 20 cents in the rand. So in this case, if we bought the debt of 100,000, we bought it for 20,000 rand. So I can offer a settlement discount to the customer to help them get out of debt, but I can still make some money out of buying that debt, because all of us are doing it from a commercial, standpoint.
So I think it's quite an important point that Ian's raised is in this particular case, it was still with the bank.
Yep.
And in fact, when she got the SMS from the debt collector, we were like, she sent it to me and I said, we need to check if this is legit, because it sounds like too good to be true. I mean, 65% discount. So we contacted the bank. And the bank said, yes, we have, this is a collector on our behalf. So we knew we were dealing with a legitimate company and we knew it was a legitimate offer. But then you could also be dealing with the debt collector who's bought the debt. How do you know?
Mm.
So generally what happens, so when credit providers hand accounts over to companies like myself as an external debt collector, they notify the actual customer that your debt has been handed over to, in our case, Alefbet Collection Recoveries, for the purpose of recovering the full outstanding balance. Once they send that communication out, we send a communication out to say your debt has been handed over to us by Bank X or credit provider Y, so that the actual customer knows where their debt is. So this is not a fraud or a phishing scam or anything like that. So the consumer always knows where the debt is if they're reading their communications.
Yeah. I was about to say, I think for me, what was fascinating is the fact that, Ian mentioned that the bank would have sent her an email that we are handing over your debt to a company X. So it again brings to the point that a lot of the times when people are financially strained, they block out all communication. And sometimes it is communication that is going to help them.
Yeah, very interesting. But I suppose one of the other things for me, Ian, in this case was, well, why don't we all just wait until the bank offers us a 65% discount? Why pay the debt?
Well, I think that's a bad option. First of all, upfront, when you take out the debt, you get a pre-agreement quote from the credit provider that will explain to you all the terms and conditions and how much you're going to pay in repaying this loan, from an interest rate, from fees, from credit life. And that's a requirement of the National Credit Act. They have to declare that to you. So if you're not paying your account, you're getting the compounding effect of interest and fees added to the account and then interest on that. And that'll compound over time. So the debt will grow quite quickly if you're not servicing your debt every month. And that's why it's also important, if a consumer is overwhelmed with their debt and find out they can't service the debt, they should talk to their credit provider as soon as possible. Because the banks and credit providers have forbearance policies where they want to work with the customer, because there's only so many credit-worthy customers in the country. If you keep writing them all off, who are you going to do business with? So they have a vested interest to keep good credit-worthy customers on board with them so they can do business in the future.
So what would that call look like, Ian? Because you just mentioned forbearance.
Yep.
And you're saying I should pick up the phone and call the bank.
Yep.
What would that call look like? Because I think we often say this, but we never tell people, what do you tell the other person on the other line?
So you always want to be honest, and that's where the bank's got to assess, or the credit provider. So do you have a short-term or a long-term issue? So you could have my car broke down. You could have a death in a family. So there's a whole lot of real reasons that happen. But if you phone your credit provider and say, look, I really have a problem because of this, and you open and honest, they can then do a forbearance policy. It doesn't forgive the debt, but they could do things like a payment holiday. I see you've got a short-term issue because you had to pay school fees or university fees for your child. So they could then say, okay, I'm going to give you a payment holiday. You don't need to pay for January and start paying again in February. But they must do it with their eyes open. So that's delaying the payment. Any delay in the payment is going to result in more interest and more fees because the debt will be longer. So you must always look at all the options and understand the options from the credit provider. So that's one example you'll talk around. The other example, they could then say, okay, I see this is the longer term one and you can afford 50% of your installment. So they could reschedule the debt over a longer period of time so you could afford the debt. But again, do it with your eyes open. The longer you pay the debt, the more interest and fees you're going to end up paying. So you've got to do it. Is this the best option for you as the consumer? That's how you've got to think about it.
And what is the impact going to be on Voyi in terms of her credit score? So yes, she's now settled this debt. She will be debt-free in September. But how long will it take before anyone's prepared to lend money to her again? Because I think that's the other part of it. When you stop paying, you don't get more credit.
Correct. And you lock yourself out. So, and I think consumers in South Africa need to start looking at their bureau record and their credit score as an asset. The better I am at paying my debt, the more people will be likely to give me credit. So I have access to more credit when I need it, and I can get a better pricing. The higher the risk you are, the higher the interest rate you'll pay. And at a point in time, the credit provider will say you're too high risk, so I can't give you credit. So there are rules about the retention on the bureau under the National Credit Act. So most of it is kept on there for about 2 to 3 years. So after 2 to 3 years, it'll fall away. But the bank that gave the discount here knows I gave a discount. So then they're going to rush in to lend her money again, knowing that I have to write off 65% of the debt, because it is a commercial reason that people do it, is to make money, whether you're a bank or a credit provider. So generally, 2 to 3 years, another bank assessing her risk will probably give her a facility again based on a bureau score and a credit score. So that's kind of roughly how it works from that perspective. But generally, the credit provider that has been stung a little bit, having to lose money on an account, won't generally go back to that same consumer and offer them facilities again.
But I mean, Mapula, that's actually a very important point, is that you can say, okay, well, I'm just not going to pay my debt. I'm going to wait for the settlement, but it's going to shut you out the credit market for at least 3 years.
Correct.
And definitely with the bank that gave you the discount.
And also the discount is not 65% off your original debt. Because remember, the debt has now got interest and got fees and it's now compounding. So you're getting a 65% discount of the balance at that point in time.
So it could be
way more.
It could actually be that the discount they gave her was the original amount that she owed. They're just almost writing off all the compounding. So it's not like you're getting away with not paying your debt.
Correct.
They're just giving you a discount on all the interest and fees that have compounded during the period that you didn't pay.
Correct.
Okay. I mean, that's important.
Sure, very important. So if it was 100,000 originally, you could find that the 65% is actually off of 90,000.
Yes.
That is absolutely scary.
So I think I think it's important that we don't send a message out saying, everyone, don't pay your debt, wait for the bank to give you a 65% discount and go with it.
Also, Maya, it's not always 65% off, right? What sort of percentage, what sort of range are we looking at?
It varies, and it varies based on the credit provider and how much they've provided on the loan. So as an external debt collector, and we collect on banks and credit providers, they actually give us a mandate. So in some cases, they could say you can give 10% discount or 20 or 25. 65 will be near the top end of the range, from that. And that'll be a debt that is, they're either about to write off their balance sheet and they're holding a 70 or 80% provision. So if they get paid, the 35% and it's only worth 20% in my books, then it actually helps them on the income statement. So the money they get is more than what their holding value of that loan in their books is. So from an income perspective, the credit provider is better off by accepting the 65 in this specific case.
So it makes sense. So it means that they've been phoning you and coming after you for many months. Yeah.
But I want to ask you, what happens? So now the bank, if she was unable to take that offer,
yes,
it would probably now have been sold, taken off the balance sheet, sold to a company like yourself. What starts happening then? So if you get this debt, every time, because you get these phone calls, does every phone call and every SMS add to your bill? How does that cost, how does the cost start increasing?
So perfect. Very, very good question. So definitely as an external debt collector, we are entitled to charge fees for various activities, making a phone call, sending a letter, receipting fee on the account. So the more effort we do as an external debt collector, the more fees and interest will be added to the account. So it's important to reach out as soon as possible to reduce those fees because of the compounding effect of that over time. So you don't want to avoid talking to the debt collector or your credit provider. Again, advice, always do it as soon as possible, enter into an arrangement. That'll reduce how quickly this debt is growing.
Just maybe I want to just bring in quickly the Induplim law, though, because everyone says, there's Induplim. It can't go to more than, so if I borrowed 50,000, it can't go to more than 100,000. How does that work?
Yeah, so that's exactly what it is. And there's a bit of grey area in the legislation, but the general principle is that your debt can't be more than twice the capital, at which case then you cease charging any debt collecting fees or interest on anything like that. But in this example, if the person had, taken a loan for 100,000, that means it could have been up to 200,000, because of interest and fees. So there's quite a lot of headroom that the consumer will be worse off if they avoid taking those phone calls, responding to those SMSs or emails. So always better, talk to your credit provider as soon as possible.
But Ian, there are many people on TikTok specifically who will say, yes, it is a good thing. Do not respond because then your debt will be prescribed. Yeah. What does that mean?
Yeah, I have a case at the moment of somebody who's just not paying. He said, I can't pay, I'm not paying, and I'm avoiding all those calls because I'm waiting for prescription to apply. So I think this is a very important question,
Yeah, so there are the defences in law for the consumer, which I think are good ones. The one we spoke about, the Induplim cap, that's one defence. Prescription is the other one. Now, prescription can be interrupted. So things that interrupt prescription is acknowledgement of the debt. So if you are phoned and you acknowledge that is your debt, then that interrupts prescription for 3 years, because that's the 3-year period.
But I must just interject on there, because one of the people who've just taken on now, they say whenever the creditors phone, they act like they are of
a foreigner or something. Yeah, they pretend that they're not them.
Yeah. So is that acknowledgement? What would be considered acknowledgement?
So that's not acknowledgement, that's debtor avoidance. So the person is avoiding putting your head like the ostrich in the sand and trying to avoid this, and hopefully it goes away. So one thing is about acknowledging debt. So if you're not taking the calls, you're not acknowledging the debt. So that one's not there.
So if I were to pick up the phone, my phone and say, Mapalo here, how can I help you? Is that acknowledging it?
No.
Or you will have to, I will have to say, okay, I acknowledge the debt. I'll see what arrangements I can make to pay off the debt. Is that acknowledgement?
So that's close to it. So first of all, we've got to identify it's you. We've got to authenticate I'm talking to the right customer. Then we've got to advise what we're phoning in Bank ABC's credit card. This is how much is due on the account. Will you be able to make the payment? You say, yes, I know it's my debt and I can pay this or I can't pay this. So once you're acknowledging the debt itself, that's acknowledgement. So as an external debt collector, we need to understand it's you. Second of all, we've got to then confirm the amount and the account that you have. That's acknowledgement of debt. But that's only one interrupter prescription. The other interrupters is I can summons you. So if I summons you and it's served on you, that interrupts prescription for 3 years. The next one is if I go and get a judgment, that interrupts prescription for 30 years.
And this is what no one understands, is if the debt's big enough, and I think, Ian, you were saying about 20,000, if it's more than 20,000, the creditors will probably take legal action. And they will issue a summons and prescription goes away. So this advice of just avoiding your debts and let it prescribe, not a good idea.
Not a good idea. And I mean, if it's interrupted and you have to pay, it's the judgment for 30 years. You have to pay.
Yeah.
You're going to have to pay.
And they can attach your assets.
Yeah, so you're going to do emolument attachment orders. They're still available. It's a longer process. So emolument attachment order, you can attach a person's salary, but you've got to go in front of a magistrate and do a means analysis. So we could attach your salary to pay the account. We could attach your bank account to pay the account, or you could attach your assets. And that's a more draconian approach. So most, sort of debt collectors, we try to work with, the consumer to bring them up to date again. That's the harshest part is when you actually take, assets back and go through a court.
And one of the interesting things, there was a judgment, there was a ruling around induplement judgments. and this is still a little bit of a sensitive space, but basically under current law, because it was overturned, if you say, for example, by the time the judgment's issued, the judgment's 100, maybe you started off with 100,000 Rand loan. It's now 200,000. You've hit in duplum. Once that judgment is given, it's seen as new debt. So it's now can go from 200 to 400,000. And that's what people don't realize. So if you get a judgment against you, it resets the top level of what you owe. And then duplum sets in again for that larger amount. So this is not a road you want to be going down.
Yeah, definitely. In all cases, avoidance is the wrong route. Talking early as soon as possible is always the best route. You will find a solution with your credit provider. They're not out here to abuse anybody. They're out here to work with you if you are in trouble. And that's always my suggestion: as early as possible, talk to your credit providers.
One of the things people often bring up, you can see that you're getting yourself into trouble. Is it possible to pick up the phone and say, hey, I've been a good paying customer. Can I lower my interest rate on this debt? Can you do that once you can start feeling the friction in your finances?
So generally they won't do that because, when you start off, they assess you based on your risk and they price the loan based on your risk. Once you're in arrears, you're becoming a higher risk customer. So you use interest and fees to offset the risk. So now you're showing you a higher risk. So sometimes they will give you a interest rate holiday or a lower one. But in most cases, they would rather, reschedule the term for you, give you a payment holiday, because they still need to keep the interest rate margin intact and their profit margins intact to run a profitable portfolio. So if they lower the rate into losing money, then they'll cut off a whole segment of the population they wouldn't lend money to. So they've got to, balance the needs of a distressed customer with the profitability of a portfolio. So that's kind of how they would think about it. So I haven't seen a lot. There are a few cases where they lower the interest rate to try and help. But generally, as a credit provider, they won't. But in debt counseling, there's the opportunity to do that.
I want to get onto debt counseling, but before we get there, you mentioned TikTok just now. Yes. And Ian, there's one TikTok video that I've seen, there's probably many of them, where they say, once the debt has been sold to a debt collector, the debt collector cannot bring a judgment against you. And I want you to comment on that.
That's totally incorrect.
Thank you. Sorry, just here, TikTok people, it is totally incorrect.
So when we buy a debt from a credit provider, we step into the credit provider's shoes. So we have to be registered with the National Credit Act as a credit provider. We then own the debt with all the rights and obligations under that debt. It then becomes our debt. So we can enforce it as the principal. So we can take a summons, we can take a judgment, we can do all of those ones. Again, for small debt, you don't generally take legal action because it's a big cost to go through the legal process. Rough rule of thumb, I use 20,000 Rand. Above 20,000 Rand, I will potentially, not always, but I will potentially take legal action. And not always below that, I won't do it. Some cases I'll do it just, to prove a principle. If a person's just playing the system, then you would say, no, you're really playing the system here. You've got the means to pay, you're just choosing not to pay. And so sometimes we will, even below 20,000, we'll do it. But generally, I use 20,000 as a rough rule of thumb, but definitely 100% wrong. I'm the credit provider when I bought the debt, and I can legally enforce it.
Do you want to get into debt consolidation before we get into debt review? Because I think maybe let us explain the difference between debt consolidation and debt review. Which one is best and when to use which one?
Yeah, so I think both of that is about your personal circumstances, but again, do it with your eyes open, understanding all the rights and obligations and consequences of your action. So a debt consolidation, you're taking a number of debt, putting into one debt and paying it off over another longer period. So putting all the debt together that you may have paid off over 3 months or 3 years, and now you put it into a 7-year loan. Go and look at your pre-agreement quote, look at how much interest you're going to pay, how much you're going to pay in fees, and how much you're going to end up paying in total. Paying off debt in a shorter period of time is always better than a longer period of time. So it might sound attractive that I'm moving from a 20% interest rate to a 15% interest rate. But if I'm going from 3 years to 10 years, I guarantee you're paying more interest on that debt. You will be worse off. So rather, as we spoke about the earlier customer that spoke to the family in tough love, we've got to reel your expenses in and try and pay it off over the shortest period of time. Also pay your highest interest-bearing debt first. So that's important. Okay, so there is a place for consolidation of debt to lower your monthly payment. but you will be paying fees, monthly service fees for a longer period, interest for a longer period. But there is a place where that can solve your situation and take away, the endless phone calls you're getting and the emails and whatever you're getting, so you can get peace of mind. But make sure that on the debt consolidation, you can afford the new payment. Because you don't want to just get out now and in 2 months you're back in again on a bigger loan over a longer period.
So, Ian, it's so interesting you say that, because I think, yes, if you have no other options, you can't pay off the debt, and the debt consolidation gives you that lower monthly installment, and yes, you'll pay off for longer, and maybe your life changes. Maybe in a year's time you get a promotion, you can accelerate that debt repayment. So there's definitely a place for it. But one of the things I find, Abelo, is that people go and take that debt consolidation loan, and then they go and carry on taking on more debt. So they take all those small debts, they take debt consolidation loan, and then they still go and start borrowing again.
Yeah.
So it's not changing the behavior and the habits. And I think and then people end up in even more debt.
And there are some consolidation companies that I think are pushing the boundaries a little bit. So the person is in trouble. I now do a consolidation loan, and they say, okay, I'll consolidate your loan and I'll give you X amount of money you can take now. So that's the worst one.
I see that all the time. The person only needs maybe 50,000 and they go and give them 80.
Yes.
And they give them an 80,000 rand loan. And suddenly, and when you stretch for cash, you think, oh, yes, an extra 30 grand. Great, I'll take it. Yeah. Big
and the worst one, that actually 30,000, I'm going to go on holiday over the festive season. So you're using it for consumption, which for me is bad credit.
Yeah. Instead of saying, no, I'll only take the 50 and make sure that I can get out of this loan as quickly as possible. Yeah, very.
But I think, just as with, and I'm sure they're good banks, but just because you get offered something by your creditor does not mean you can afford it. Just take what it is that you need and stick to that only.
So interesting. And I was talking about the case. There's one of our new little mentees that have joined the program. And, he was saying to me how he got into debt because he just kept getting all these offers. People kept offering him and offering him and offering him. And he was like, I was thinking, oh, it's only 500 rand a month, or it's only 1,000 rand a month. And suddenly it just starts growing and growing and growing and growing. And I think you are the one who has to be responsible. You can't just assume because a credit provider is giving it to you that you can afford it. I think that's a very big one. But also, Maya, remember, again, they don't think that it is a lot of money, but also you have a credit provider, this trusted institution, and you're thinking, oh, clearly it means that I can afford this. So you can actually push back and say no.
I think you could do that. And you could also say, I don't want that 80. I only need the 50 and take what you really do need. And I do think in South Africa, we've got, great banks, great institutions. Of
course, we are represented by a bank.
So the intention is good, and they do affordability because they have to do it under the National Credit Act. So they've done the affordability calculation. So at this point in time, you can afford the loan based on your income and your expenditure. But you don't know what happens in the future. If something goes wrong, then suddenly, you have a bit of an issue.
Yeah. And often it is a job loss.
Yes. Yeah.
It's a big problem.
But also, I think what I'm hearing is a lot of the times credit providers play with two things: your interest rate and the term of the loan. So always be aware of those two things, because the higher the interest rate, the more that debt is going to cost you.
And you do have every credit provider has to give you a quote.
Yes.
So that you can see your total cost over time. And that's a very good way to say, what is this actually costing me in total? Don't just look at that monthly installment, because that monthly installment may look small, but when you look at that total amount, that really gets expensive.
And the whole purpose of the pre-agreement quote is so you can shop around. Okay, there's competition between the banks, between the credit providers. Shop around for the best interest rate, the best fees, and the term that suits your requirement. But my recommendation, always try to do as short as possible. Time value of money and the compounding effect hurts lots of people worldwide, not even in South Africa.
So we dealt with debt consolidation. Be very careful. Understand what you're taking on. Now, unfortunately, there's a lot of people who get debt consolidation and debt review mixed up. And debt review is a court-ordered basically agreement. And I think that's very important to understand. So Ian, take us through debt review.
So debt review, or known as debt counseling, so that is a remedy and a protection for the consumer, and it does definitely have a place. So if you're going to go into debt review, it can safeguard your house or your car. So if you're in that process, then your credit providers can't take legal action if you keep to the agreement going forward. Okay. So it does give you protection for your assets, and it does definitely have a place. So if you are over-indebted, you can go to debt counseling or debt review. People use that interchangeable, but you have to be over-indebted. That's the first issue to go in. Then also when they put the arrangement together, it has to solve within 5 years. Okay. But if you do sign and you go under debt review or debt counseling, you're then locking yourself out of the credit industry for 5 years. Because if we go to the bureau and we then see you under debt counseling, a credit provider can't give you more credit. Otherwise, they're going to be deemed to be reckless. Okay, so that's the one thing. Where it does have a good place and you are over indebted, they would look at all of your debt and then say, okay, if I extend term, can I solve this and bring it back in line with your affordability? Can't do it? Can I then reduce the monthly service fees, bring it in line? Can I start reducing the interest rate? And so they will look at all these plans to get it back to be affordable. And so that can help you with saving interest and fees when you're under debt counseling, because it is a remedy at the very back end. It's not for a front-end customer that can still afford it. So there is definitely a place with it, and there are very good, reputable debt counselors out there that do a very, very good job of helping people get out of debt within a 5-year span. And there's lots of good cases where people have said, I went into debt counseling, worked perfectly for me, I've come out the other side, and I'm debt-free.
Yeah.
And so it does work well.
Yeah. So obviously it is within the 5-year period. Can you pay off your debt a bit quicker and get out of debt review before the 5-year period?
So you can do it, but generally you then got to settle all your debt. And then the debt counselor has to remove the flag on the debt help system, which is run by the National Credit Regulator's Office. And so they can remove the flag if you've settled all your debt. But like we all know, you're not going to end up settling your car because it's a longer period in a shorter period of time. So for people that only have unsecured and no car and housing, definitely, if you've paid off all your debt, you can be taken out of debt review because you're out the other side.
So I know a house, you can exit even if you still have your
Yes,
they do allow that.
Yeah.
But a lot of the cases you would need to settle your debts that are under that. That are under that court order.
Yes.
But I must say, Ian, we had someone last year who went under debt review on the Money Bootcamp program, and they one of the things that the debt counsellor did is they went and applied for reckless lending for all the payday loans, because effectively they were reckless lending. He couldn't afford them. I mean, he did not have the money to pay that. So immediately they wiped out a whole lot of his debt just on reckless lending.
But that was under debt review, because I don't want people to listen to this and hear.
Oh, no, this is under debt review. So I'm saying this is a benefit of debt review, is that under debt review, your debt counsellor can look for reckless lending. And in many cases, they can actually remove some of those debts. So there is, as I said, if it's a good debt counsellor, they can do great work. We won't go into the many articles I've had to write about bad debt counsellors. And I think that in there lies, like everything, like debt collection, like anything in this industry, they're good people and they're bad people. And you just want to be working with the good people.
100%.
100%.
Well, Ian, I mean, I think this has been absolutely fascinating for me. But I want to end off with just one question, because I'm actually dealing with a case like this. You are over indebted. You actually cannot meet your debt repayments. You haven't paid your debts for maybe 18 months. You don't want to go under debt review. How should you start negotiating?
Well, I think the first one is to have an honest conversation with yourself. First of all, what income do I have? Actually do your budget, draw down, what is everything I've got to pay? So I've got to pay for housing, I've got to pay for transport, I've got to pay for food. These are non-negotiables, I have to live. What have I got left to pay this? All these other debts. And then look at that, okay, so how does it work? Where are my accounts? And I've ignored it for 18 months. So are there summonses, are there judgments, what is it? Have a look at all of that debt and then say, okay, tackle the ones with the highest interest rates first and then work your way down from that. Approach your credit providers, because if it's 18 months, there may be a settlement offer there, and approach each of those and say, okay, within my means, how much have I got to pay? And can you offer me a settlement discount? Now, they'll sometimes offer you one in a single payment or 2 or 3 payments. So you could get a settlement one, and you could say, okay, I can't pay now, but I know I'm getting a bonus in October, November, December. Can I do a settlement then? And I say, yes, okay, we'll give you a settlement. Then contact us then in those months. We'll tell you what your settlement at that point in time is. So you could then say, okay, if I have a discount on these ones, I can afford to pay it. Okay. Or we can do that debt consolidation piece. It doesn't want to go to debt review or debt counseling. So it'll be consolidation and discounts.
Well, unfortunately, consolidation, they can't lend you if you've got a bad credit record. So it gets tricky.
But what they can do, they can consolidate all the loans So then they look at all the loans. If I consolidate your 5 loans into one, I free up affordability. So then they do affordability calculation. So it's not reckless because income less expenditure, you still got some money at the end. So that will work. So it always starts with, financial discipline as a person, being honest with yourself, and don't hide debt. I've got to ignore that one. It's all part of your debt. Put everything in and be very brutally honest with yourself. And then also say, these are nice to haves. These are need to haves. Nice to haves, stop spending, because that's individual financial discipline. You've got to stop. You're spending more than you've got. You have to stop something. Otherwise, it's permanently going to be over-indebted.
Yeah. And I think just another thing I want to add to what Ian was saying, being reflective, number one, for sure. But another very important thing, download your credit report, the entire thing, because it will give you all the information of the judgments and what is going on exactly, so that when you're reflecting...
And who earns your debt.
Exactly.
It'll all be
It'll all be there. It will be there.
So that's really your credit record is where you can find all of this information. Say, okay, who's got my debt? At what stage is it?
Not just looking at your credit score.
Not just a lot of people just look at the credit score. Yeah, absolutely. Really good advice. Yeah.
And then maybe to add to that, and all credit providers have to update the bureau on a monthly basis on how your account's been paid. Okay.
Well, thank you. That's been so interesting. And I think just given a really, really great insight. So thank you, Ian, for joining us.
Pleasure. Thanks very much for your time as well.
And join us for our next episode where we look at family.
Yeah.
Oh, yeah. Like how, and I think about Vuyi, supporting 20 family members. She's a really good example of somebody who had to sit down and say, what can I do? Where do I need to draw the line? And that's our next discussion.
Absolutely, Maya. I can agree with that conversation.
So join us.